Stocks fell for a fifth time today in the last 6 trading sessions, but we got a long lower shadow near an important support. So I'm going to break down how important that support level is, the difference between a near-term pullback and an intermediate-term pullback, what that means in terms of our expectations for trends going forward, what's driving this price action, what's driving this weakness, where's there some strength, and how we can take advantage of that. So let's go ahead and get started. Today is Wednesday, August the 15th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the logo here in the bottom right corner of the video. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like tonight's video, you got something out of it, and it lets me know that you want me and Brandon, to keep doing these videos day after day. Also, comment on anything that stands out to you from tonight's video. You have to scroll down further to the comment section. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 and see how today's move showed up on the market forecast indicator. You see down here at the bottom, the intermediate line stayed, even with this, 6-day losing streak with, 5 out of 6 days being down. The intermediate line is still up above 80, and we've pulled back before. We pulled back here during that 4 out of 5 day losing streak before bouncing up. So we're at that point again. Market sentiment's also falling. So weak. If that intermediate line was at 79.5, either way you have a weak bearish posture. Obviously you're still trending higher. We closed above the upward trending moving average, so it's still green. It will be green tomorrow based on today's result. The near term line actually bounced up, interestingly enough. Got up above 50. Now it's above 50, which means it's open now for a new near-term high. Now, if it pulls right back down tomorrow and ends up being a bearish near-term high on the blue line is defined as a peak between 50 and 80 that corresponds to a lower high on the chart itself. So we end up with a bearish high. Now things get a little sticky there, but as of right now, it's rising up higher. We got a strong bullish posture because it closed at 81.5 and not 79.5. And market sentiment, like I said, showing a very, very weak trend there. So interestingly, we rallied off. We hit 2,800, close to it on the low, just a couple points away on an intraday low basis. Before rallying 16 points off that low to finish where we did there at 28.18. So it wasn't as bad. A long lower shadow, I tweeted that out today. Keep an eye out for that long lower shadows. Those tend to be bullish, especially at support. So good sign for the markets to get that long lower shadow. We'll take a look at some of these other indexes here. You see that the long lower shadow is even more pronounced on the Dow Jones. Now, its intermediate line did drop below 80, so we have pink shading, but light pink. Remember, light pink shading does not end the intermediate run. It's actually the dark pink shading that signifies an intermediate pullback, which means you have to get the intermediate line down below 50. So just because we have a weak bearish posture doesn't mean that this bullish run is over, right? It's actually still going. We just have a little bit of weakness here right at the moving average, and it'll turn yellow. Let's see, the moving average is there at 25,179, and we close at 25,162. So actually the green, that moving average line will turn yellow tomorrow because we are down below an upward trending moving average. But you see its short-term sentiment also bounced up higher, and the near-term line is above 50. So again, setting up the potential for a bearish near-term low. The intermediate line and the intermediate run would suggest that will bounce off of here and continue higher. Whether or not we get up to new highs or not, that will dictate how bullish we are. But the intermediate posture, even though it's weakly bearish, the fact that we're still on this intermediate run would suggest that we would bounce off of this, especially with the long lower shadow that I mentioned. NASDAQ got hit harder A little bit of a doji pattern here. I have a long upper shadow as well. Also showing weakness just barely above 80 on the green line, just barely above 50 on the blue line. So similar pattern developing, a little bit of an ascending triangle, kind of a wedge pattern forming here with some higher highs and higher lows, but the higher lows are at a much steeper angle than the higher highs. That's called a wedge continuation pattern. And then finally the Russell 2000, you'll notice still kind of stuck within this kind of sideways consolidation. I've got the lines drawn actually on the ETF IWM. You see that sideways consolidation there. That's where the Russell is. So you look at, I brought this up actually in a class, we had a really extended consolidation pattern that we broke out of here. So a lot of volume in this area that we broke out of, and typically after you break out of a pretty good consolidation pattern, you consolidate again. And so that's kind of what we're doing on the IWM, on the Russell 2000s. We're consolidating after a pretty good breakout. Remember, the SPX did not break out yet above that, right? So it's a little different than what we're seeing in the Russell. So the Russell did. So again, the expectation is you break out of a strong range, a long extended range. You break out of that range, you're typically going to get some kind of consolidation. This one's lasting a little bit longer because the S&P hasn't broken out of its consolidation. So another sign of expectations of upside potential. Now its posture is bearish, like all the rest. You can see its intermediate line is dropping below 50, but like I said, or dropping below, close to dropping below 60. But hasn't dropped below 50 yet. So again, that's when the intermediate run that just barely started a week ago would end. So we'll keep our eyes. There's the intermediate lows that we formed, and there's the intermediate highs. So until we break out of that, we've got the same kind of pattern developing on the intermediate line as well. You see its near-term line, like the others, up above 50. So very important to see where this next near-term bounce that we're currently actually on, even if it's just intraday today, where that near-term bounce takes us. If it can get up to at least the previous near-term high is great, but if we end up peaking without getting into the reversal zone above 80 and at lower highs on these indexes, then that's when you expect the bullish intermediate run to end and turn into more of a stronger bearish pullback. Again, because of the trend, we're not looking for bear markets here to develop. It would just be because there's the last intermediate low point that we had, and then we got a new one here that we bounced off of, and there's that one. So the reality is, we start pulling back here more on there we go. We start pulling back here. We still got a lot of Fibonacci resist or support to hold us up to the previous intermediate low point. So it would just be, just like this one was, an intermediate pullback. I know, once we get dark shaded pink, that's when the sentiment out there goes crazy. Like I mentioned before, the scene in the movie Airplane when the stewardess says they ran out of coffee. Airplane 2, I think, and that was tweeted to me from a Market Scholar client student. And so that's kind of how I envision the marketplace, at least the retail marketplace, to get when we get that kind of move. But the reality is, it's just a pullback until we break that intermediate low point there. There's no any pullback would just be that, and it wouldn't be a bearish trend yet until we break to new, or even did not get up to a new intermediate high. See, we're coming down from a higher intermediate high point. So, in fact, we even talked about that. If we break through that, we talked about getting up to that old high point, which essentially we have, and now we're getting some weakness. And if we were to bounce or base in this area where these old highs are and this Fibonacci retracement zone is, then we'd have a much more solid low point, a much higher low point to bust up through that high than we currently have. Being that far extended away from that low point that we bounce off of. So think about like a trampoline, right? You bounce off a trampoline and you get up. It's kind of hard to keep going up once you're already that far off the trampoline. But you come back down and you bounce off the trampoline here, then it's easier to bust through, right? Then it's easier to bust through there. Alright, a reminder that you can watch our Market Outlook videos on our Market Scholars blog. Here, again, go up to marketscholars.com, click on blog. There's our video embedded in the page. Usually it's going to be posted at the top of our blog more recently. Again, we ask if you like this video, you want us to keep doing this video, you can tell us with 3 easy clicks. You can do it right now while you're watching. Just scroll down, click on that heart. That lets us know that you liked the Market Outlook tweet. Again, you can click on that icon that takes you to your Facebook page where you can like it there as well eventually. And then finally you can click on that like button there on our blog, and that sends out through the WordPress network. Remember too that you can share the Market Outlook blog post here to others through these links. Again, our goal is to try to get that number up to 100. So if you like this video, you would recommend it to others, then click on either one of those 3 links, and that will share it with people in your networks. This pullback got us down to the 50-day moving average today. Did not get us through it. Now the week's not over yet, not over yet either. So we still got a couple more days left. We'll see if we end up bouncing off of that. But as of right now, the price is still above a rising 50-day moving average, still above a rising 200-day moving average. The gap is falling a little bit, but we still haven't got that arrow yet on the 50 that would suggest even the possibility of this happening. I remember aside from that big drop in January, last few times we get these red arrows when we're on a good market sentiment run and we're expecting these intermediate rallies. These are the intermediate pullbacks when you get that red arrow on the 50-day moving average. So you get it, you expect to bounce. We actually had another intermediate pullback, a short-term one right in here, and then we bounce. So again, it's okay actually. It's when you get the end of a market sentiment run, which is about a 6 to 9 month period, and you start to get more arrows kind of back to back to back. That's when you get more of a deeper pullback that brings that market sentiment line down and sets you up for a better launching point going forward. Looking at the 3 green arrows, we still only have 2, so we're still above a rising 30-day moving average. And you look at the 2-line version of this chart, and you can see both the MACD and stochastics are declining. We are now below the 17-day moving average for the second time in 3 days, but still not below the 30. And you can see the 8 is still above the 17. That's why the MACD, the blue line, is still positive. It hasn't crossed below 0 yet. But we're pulling back, and that's what happens when these lines trend lower. When this gets below 0 and this gets below 50, that's when you're going to be a little bit more bearish and start expecting more of an intermediate pullback, which again, that's the first thing. You expect more of an intermediate pullback just like this one was, and you don't expect a bear market or much less a bear trend until you break through that low point. Now, of course, that's not the case elsewhere in the world, but as of right now, if you look at all these major currencies on a 3-month basis, major economies, almost all of them are 7%, are down 7% or more, except for China, U.S., India, and Canada. Everything else is down pretty well. So they are on downward trends, and the fact that we're not, this shows how resilient and how bullish we actually are. So don't buy into bearishness yet until you break through that intermediate low point. Then we're going to be bearish for a little bit longer period of time. See, even back here, this intermediate low point was still at Fibonacci support of the previous intermediate low point. The pullback was so big because the intermediate run was so long and it was so big. That was still just an intermediate Fibonacci pullback retracement to a Fibonacci support zone, and we bounced off of that and hit it again, and then that's what pulled the market sentiment line down that set us up for now this rally that we've been on for a while. So we didn't quite get back up to today's high point. That's where the gap, the bottom of the gap is. So there's our opening gap on SPY. We did end up getting, though, back up to yesterday's low and the previous day's low point, so right about 282 as a resistance. And as of right now, you can see if we were to pull up SPY in the after hours, we're up above that 282 a little bit. Just a little bit, light volume, so we're kind of in this area here. So I wouldn't read a whole lot into it. But again, shows how bullish this little rally was at the end. I mean, you look at all this green. I mean, we had a lot of red here early in the day, but the green kind of took over, and especially at the end, a lot more green than red. And that's what brought us off of today's low point to finish nearly 2 points off of today's low point. So you look at the move that we've had today, lower high and a lower low, obviously. But you look at the range, which you need to add on about another point from the close at 283.90 to the high today at 282.54. So about a point and a half. Add that on to this day's range. So you almost had about a 4-point range, almost a little bit less than a 4-point range, so almost double the average range with 100 million shares trading hands. So when you put that in context, here a 4-point range is right there, and 100 million is right there. So that's actually a bearish day. I mean, it starts to pull these lines up, but not an extreme, right? If it would have been like a 200 million share day in a 5 or 6 point range, now it's almost like an immediate bounce. I mean, you would buy that dip really quickly. So we'll see. You know, this move is a bearish move. All those lines are rising right now, and those numbers are repeatable. Right? We can get another 3-point range day. We can get another 100 million shares, and wouldn't be out of the ordinary. The range there on the absolute relative basis is still below 1%, so we're still in this bullish trend. But if we get another day or two like that, 3.5, 4-point range, 100 million shares trading hands, those kinds of moves, then we can break through that 280. And again, breaking through 280 basically will be an intermediate pullback, and we'll be watching that Fibonacci zone and that low point to see if this bullish market sentiment move is over at that point. So I don't expect that. Based on the trend and based on the fact that we still got some time left, I actually would expect this Fibonacci support range to hold, if not now on this near-term basis, eventually on an intermediate term basis. So I'm not looking for a new bearish trend to develop anytime soon. Again, simply based on how high market sentiment is and how recently it just barely came up above 50. You can see volatility pull back. We did peak up above 16. We dropped all the way back down to 15. 15 is a key level. So breaking below 15 will be important to maintain to keeping this to just a near-term pullback. Bouncing off here and staying up in the high teens will most likely to more than a near-term pullback and more of an intermediate-term pullback, which again that would mean breaking below 280 on the SPY and looking more bearish. So you can see what's going on. You've got some divergences, even though I wouldn't read a whole lot into divergences on volatility, especially on an intraday chart. This is an important thing to look at. You can see we did bounce up. It did not bounce into the bearish range. So that's a very good sign from a bullish standpoint that the volatility didn't break up above 95% and is still in the neutral range. So that first attempt at resistance is the 90% when you're bullish. The next attempt at resistance is 95%. Then you get up here, you get the intermediate term pullback. So we'll, again, just to kind of show you the last one that we had, the last intermediate term pullback was right there here in June. So the reminder from a time frame perspective, pull up SPX here. So there's the intermediate term pullback at the end of June, right? So I'm going to go back to the volatility index here for N, and then we'll look at the 6-month chart. Okay, so there's the last intermediate term pullback where we did get up, we broke up above 95 into that bearish zone. So we've had our first attempts at holding in the bullish zone. We didn't. So now we got that next area of resistance at 95%. And so again, you expect that resistance to hold until it doesn't. So we expect this to be more of a near-term pullback and until that 280 level on the SPY or 2800 on SPX breaks. Until it breaks, we expect it to bounce. If it breaks, we expect just an intermediate term pullback until we hit down to lower lows. Now, are we going to follow suit with all these other major indexes? Most likely not, because we don't have the same issues that most of those other countries have right now from an economic standpoint. We're on the other end of the spectrum. And while the weakness, while an overall bearish investor sentiment's bringing everybody down, at least weighing on everybody, you can see it's not weighing on the U.S. stock market as much compared to everywhere else. I mean, you look at China, it was down nearly 5 times as much as the S&P 500 today, over 4 times as much on a percentage basis. So again, perspective on these pullbacks. It's everything's relative. Nothing's in a vacuum. The fact that the S&P is down today, okay, it's down. What does that mean? How far? How far down is it? Well, 75 hundredths of a percentage point. Okay, well, 75 basis points. What does that mean? What are the alternatives? What's the opportunity cost, right? If I'm not in the S&P 500, I'm in something else, what would I be up or down there? And how does that compare to a 0.75% loss? Well, if you were in any other international area, especially the more developed markets, you'd be down a lot more. So that kind of shines a little light on just how much or how much of a loss this is. So to sum up, we're getting a pullback, needless to say, right? We're getting a pullback, that's obvious. Right now, the market posture in these charts would suggest that this is just a near-term pullback, at worst down to 280, and we expect to bounce off a higher low point and move that we already maybe have on an intraday basis with this long lower shadow and continue to move higher. 280 being a key level that if we break, that would turn into more of an intermediate term pullback. Again, not expecting the kind of losses we're seeing in other countries right now, but more weakness until things get settled in some of these other areas that's weighing on the U.S. markets. So again, that's if we break 280, which I don't expect based on what the charts are showing. Doesn't mean it can't happen, of course, and it wouldn't be the first time something happened I didn't expect. But that's kind of what my market posture is based on what we're looking at on these charts. So tell me what you think. Do you agree with that, or do you disagree with that? Let me know by clicking the poll in the top right corner of your screen. Click on either agree or disagree. One click poll. If you click on disagree, which is perfectly fine, would love to hear what you're seeing that I haven't brought up that would suggest either, that most likely would just suggest that you're a lot more bearish than what I'm reading on these charts. All right, if you take a look now at what's driving this price action today, quickly look at these charts. You can see, look at gold. The dollar continues to rise up, new 3-month highs here, about as bullish from the intermediate posture as you can get. On the other end of the spectrum, gold, new 3-month lows with a new oversold cluster. Ag commodities down to new 3-month lows. Crude oil pretty close now, the 3-month lows down almost 8%. You can see over here on the left, crude oil, it was a strong dollar kind of move today. The dollar ended up pulling back from its highs, ended up finishing there break even, but still the effects were felt overseas. There's EFA and there's EEM. International stocks getting beat up the most, and there's your commodities, agricultural and commodities there, and then crude oil down 3% today alone. So very, very big move in some of these asset classes. You can see a broad sell-off in terms of small caps and mid caps leading the way down. There's your large caps. You can see value held up better than crude oil, than growth. And you can also see too that high yield versus investment grade. There's investment grade and there's high yield. So that's a risk on. Now, investment grade also typically on a true risk off day, investment grade will also be down here too, below these these treasuries. And so the fact that it was up and the fact that gold was down so much too, that's a true, that would be up here as well, and you wouldn't have VNQ up as high. These are your real estate stocks that are bouncing off of a higher low. So, it was a sell-off day, but not nearly as risk-averse as you would expect. And of course, as I mentioned before, a lot of it overseas. When you look at the major markets, the major economies, the U.S. down, 0.75%, and everyone else forming new, China forming a new 3-month low, Japan pretty close to a new 3-month low, Germany forming a new 3-month low, UK forming a new 3-month low with an oversold cluster. France forming a new 3-month low. These are large Western economies, and these are the largest Asian economies, and they're all down, forming new 3-month lows. Double-digit losses or close to it. And India holding up still pretty well. It's been the better performer and the biggest gainer from these trade wars. But everyone else, there's Italy, in bear market territory here. Brazil close to a new 3-month low again. Canada close to a 3-month low, but in a much tighter range. Russia at a 3-month low, and South Korea at a 3-month low. So, that's where all the weakness is. In fact, I tweeted out today earlier, like, you look at these 12 charts, which one is not like the others, right? There's only one green chart on here. Everything else is pink, and there's only one line that's going to be green tomorrow, and that's the U.S. Even India's will end up turning yellow because it's below that rising moving average. Canada's will also turn yellow with a break back down below its moving average. So, there's relative strength. There's quite a bit of relative strength in the U.S. Markets. And if you take a look at I haven't built that currency, so let's pull up the currency here. And how the U.S. dollar has been up against most of these. Some of these European currencies did rally here at the end of the day. When you look at the currencies, there we go, and how they're doing. Again, that strength in the dollar is broad, all the way across the board. You can see the oversold cluster showing up in the euro, the pound. You can see Australian dollar at new 3-month lows, oversold clusters in the Kiwi, which again means that the dollar is overbought against all of these. There's the dollar against the Singapore dollar, South African rand, against the Turkish lira, and it's pulling back a little bit there. The Thai baht's in a nice little flat range. Relatively speaking, the Mexican peso has been weak, and so is the Canadian dollar. They've been relatively strong lately, but even in the last week, the dollar's been rallying against everybody across the board. So again, shows how strong that currency is right now. When you look at the calendar, you can see we had a big basket of data points. Retail sales was a relatively big gain today. Again, it came in as a little bit more than expected, but not that much bigger. In fact, right on the last number, that was actually revised lower. So that kind of offsets itself. And if you look at the year-over-year figure, which obviously is more important, continuing to be really strong compared to the last couple of years. On the retail sales front, you can see the Empire State Manufacturing, the first of the major industrial sentiment surveys, and you can see it continues to maintain a very high level, relatively speaking. Industrial production, again, we'll take a look at that on the year-over-year basis. I mean, look how it's continuing to rise and push higher. Now, not in a big extent, you can see the Economic Surprise Index, which measures those numbers versus their estimates. We're pretty much right at zero. So we're starting these analysts are getting their estimates right, which means that this growth, is starting to mature. The economic indicators will only beat the estimates kind of at that very first push. But you can see with a new GDP estimate coming out today for Q3, we're still holding estimates at 4.3%, with a new estimate expected tomorrow when we get housing starts in the Philly Fed, which is the second major industrial manufacturing sentiment survey. Some of these other the housing market index still relatively high levels, pulling back a little bit, but again, this is coming down from some pretty decent highs. And then Treasury International Capital and business inventories also. So a big basket of surveys, but it's that retail sales, industrial production, and the EIA report, which is what caused all that weakness in crude oil. That's really what pushed things down. Look at the inventories, crude oil inventories rising up a little bit, but again, grain of salt there. The inventories right now are at that much lower of a level than they were in March 2017. So, for some perspective on that, when you look at March 2017, which is right there, that was at $55, 54. We're at 64. So, again, it's going to be hard for crude oil to fall too much lower when our inventory data is still relatively low compared to where we've been before when there was such a glut of inventories. All right, when you look at sector performance and how it did today, here, let's move this to our sectors, our S&P sectors. You can see, here's the S&P 500. I've got these sectors ranked by how they're doing relative to each other and the S&P 500. Healthcare, obviously, one of the strongest movers, rising moving average, very strong intermediate posture. Utilities, staples, real estate, all kind of rallying too on upward trends. Very strong 3-month returns, shows the how we're safe haven moves into those areas. On the other end of the spectrum, tariffs have really hurt materials and industrials, and now the strong dollar is also kind of adding on to materials and energy, and those two areas both hitting new 3-month lows today. Those are the weakest spots that we have. Financials pulling back with the bearish posture. Industrials pulling back, of course, with the bearish posture. Technology pulling back with about as weak a bearish posture as you can have. So you can see what's the most bearish and what is continuing to be the most bullish if you want to rotate into favor discretionary pulling back too with the very weak posture, but better gains than what you're seeing in the technology area. So and it's been less volatile in some of these other areas too. It's been nice and steadily moving higher. So today, typical risk-off day. Staples, utilities, real estate, all higher today. And on the other end of the spectrum, your dollar-sensitive areas, materials and energy, down. Technology and discretionary, both are your typical bull market leaders, lagging the market on a down day as well. Industrials and financials actually beating the market, I think simply because they have been down so much previously. If you look at it on the 3-month basis again, industrials and financials, they're some of the weaker sectors. You have to turn it this way. There are a couple of your weaker sectors, and of course energy and materials are the weakest with the strong dollar. So that's not surprising, but those are your other two sectors that have been lagging the market over the last 3 months. Whereas staples, healthcare, and then these other safe haven areas, interest rate sensitive areas too, have been outperforming and holding up relatively well. One stock that's in that staples area that I know if you've been following Brandon, he's been a very is one of the stocks that he's talked about quite a bit here lately on Twitter and in classes and such, is Hershey's in that consumer staples area. One of the few stocks had a really good day today, up almost 2%. This stock has got an interesting move because here just a few weeks ago, after coming down to really good value area, and that's why it's been discussed, a big value node here at 92.5. But with earnings breaking out big time, of course, when you get a big move like that way outside the bands, especially to an area of volume, to a resistance area, it will consolidate, and that looks like what it's been doing. It's been consolidating with a little bit of an ascending triangle consolidation pattern. But today's move with decent volume, not getting above a Bollinger Band because it's been so wide, it's widened out so much, but holding the moving average and breaking up through this little resistance node that we've had and starting to get up into this area where it's got some, not nearly as much volume until you get up to the top end towards 105. So nice little bullish move on a day when the markets weren't bullish at all. That kind of suggests that after the big earnings breakout, the consolidation, that there's an opportunity for this to continue to push its way to the upside. If you take a look at like the market forecast chart for Hershey's here, you can see the intermediate line, which had turned up above 50 after the earnings. Again, the consolidation had kind of kept it fluctuating up and down between a strengthening bullish posture and a weak bearish posture. Obviously, turning back up today with a strong move higher, the near-term line getting strongly up into that reversal zone, one of the highest levels it's had in a while. So a good bullish move from the market forecast perspective. And then you look at the 3 green arrows as well, and you can see a new set of 3 green arrows today with close to average volume. Again, I don't need above average volume on a trending stock, which is what this has been. We've had this breakout move, 3 green arrows with a spike in volume there. Then we got the red arrows, and now we've got a new set of 3 green arrows on a trend. So there's an opportunity here to sell a put option. These are relatively wide spreads, so you want to try to fiddle around. You might have to do the 99 or the 98.5, 96.5, and you have to fiddle around with these spreads to see where you can get filled in at. Remember, on a $2 wide spread, the goal is for a 30% return on risk, the goal is 47 cents of credit. So that's where you want to try to get filled in as much as you can. 98.5 gives us a pretty decent probability of success and throws that strike price right there, right around that low point. So essentially what it would be saying is, because this is the highest close that we've got in this period, if we can't hold that close and we break back down to these lows, then we'll end up taking about a $45, $50 loss per spread compared to the gain that we're trying to make. And that's, again, if we can't hold this breakout and we break back down below those lows, then that's where we do want to get out and take the loss, and keep our loss minimal and look for something else somewhere else. So an opportunity again in a strong sector that you'd expect to continue to be strong in the face of this higher volatility, especially in the seasonal period of higher volatility heading into the end of the year, or excuse me, the end of the month. And on this last chart, this DMI chart, showing how bullish we are, being above 25 on the positive line, with the ADX also being above 20, shows we're on a strong trend. We got a strong positive direction, closing at closer to the highs of the day, closing up above. As high as we are up above the low points, that's what pushes this number up higher. So very strong bullish trend, strong move again on the day where the markets weren't so strong. It gives us the opportunity to make a little less aggressive bullish trade in this strong sector. All right, so what do you think about our trade idea tonight? What do you think about the market posture, where this market is heading right now? I would love to hear your thoughts. Click the link that's popping out in the top right corner of the screen. That will take you to our Market Outlook forums on MarketScholar.com. Remember, you can also go there on our blog itself, subscribe, and you can participate in the forums. Let's get a chatter going here. Let's get a conversation going on what you're thinking about the markets and what you're thinking about some of the things that we discussed in tonight's Market Outlook. Thanks again for watching. Remember to subscribe to our YouTube channel, comment, and click the thumbs up icon down below. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook as well as on MarketScholars.com. Thanks again, everyone. Have a great evening, and we'll see you all next time.